On a crisp autumn morning in 2008, the global financial system, long thought to be unbreakable, shuddered under the weight of risks it had accumulated in plain sight. In boardrooms from Wall Street to London, executives once confident in their models and leveraged strategies found themselves scrambling to answer urgent questions. Which assets are still worth something? Which counterparties will survive until tomorrow? And who, if anyone, will rescue them when the next moment of truth arrives? It was in this crucible of panic and betrayal that a pseudonymous figure, Satoshi Nakamoto, initiated a revolution. But before we leap ahead to the world Satoshi would reshape, let us first immerse ourselves in the story of how the old system unraveled, and why it mattered so profoundly that someone felt compelled to build an entirely new financial architecture. In the years leading into 2008, banks and shadow banks had discovered a siren song, the magical alchemy of high leverage. By borrowing $30, $40, even $50 for every dollar of shareholder equity, these institutions amplified every basis point of yield. A seemingly small rise in interest rates or dip in real estate prices could be weathered, until suddenly it could not. Structured credit vehicles in particular had become popular conduits for risk. Collateralized debt obligations, CDOs, filled with subprime mortgages promised double-digit returns. So long as housing prices continued their upward march, managers used intricate models to slice and repackage risk, creating tranches of varying seniority. The safest tranches were rated AAA, the same as U.S. Treasuries, but offered substantially higher yields. Investors piled in, confident that widespread home price appreciation was a lock. What could possibly go wrong? By midsummer 2007, the cracks began to show. Reports of rising mortgage delinquencies, once dismissed as localized oddities in a handful of coastal markets, started to swell. Big banks that had loaded up on subprime loans, either directly or through derivatives, faced unexpected losses in the billions. As losses mounted, mark-to-market accounting forced institutions to write down asset values. Those write-downs ate into capital, triggering internal leverage and collateral covenants. Firms that still looked solvent on paper found themselves scrambling for liquidity in overnight markets where interest rates spiked. In response, the Federal Reserve cut its policy rate 5 times between August and December 2007, hoping to calm markets and reassure nervous lenders. By then, however, the crisis had become self-fulfilling. Trust evaporated, and institutions hoarded cash rather than lend, fearing that the next counterparty might be insolvent. In March 2008, Bear Stearns, one of the oldest investment banks on Wall Street, collapsed virtually overnight. A run on 2 of Bear's hedge funds, which were heavily invested in mortgage-backed securities, prompted severe margin calls. Rumors of insolvency spread like wildfire. Deposits and repo counterparties vanished, and Bear's liquidity buffer proved insufficient. On March 14, in an unprecedented intervention, the Federal Reserve arranged for J.P. Morgan Chase to acquire Bear Stearns at a fire sale price. It was a watershed moment. Never before had a large Wall Street investment bank failed so abruptly. And never before had the Fed orchestrated such an emergency rescue. For many, it was a harbinger of things to come. By late summer, the crisis had metastasized. Lehman Brothers, another storied Wall Street firm, teetered on the brink. In mid-September 2008, with no buyer willing to assume its toxic assets, Lehman filed for bankruptcy. The shockwave was instantaneous. Credit markets froze, stock markets plunged, and the interbank lending rate surged to levels not seen since the Great Depression. At the same moment, the government seized Fannie Mae and Freddie Mac, the 2 giants underwriting American mortgages. Insurers like AIG, exposed to trillions in credit default swaps, required a massive bailout. And the shock that hit hardest was perhaps the realization that the largest banks, too big to fail, would indeed require rescue. The moral hazard debate raged, but the need for swift action was undeniable. Without backstop support, the entire financial edifice risked collapse. Into this maelstrom marched the U.S. Treasury and the Federal Reserve, launching programs that would dwarf all previous interventions. TARP, the Troubled Asset Relief Program, authorized $700 billion to purchase or insure toxic assets. The Fed's balance sheet swelled from under $1 trillion to over $2 trillion in a matter of months. As it extended liquidity through new facilities and direct purchases of mortgage-backed securities. Congress slashed short-term interest rates to near zero. Yet despite these efforts, economic growth stalled, unemployment soared, and fear gripped Main Street as much as it did Wall Street. The crisis had laid bare the perils of excessive leverage, hidden risk concentrations, and the unchecked complexity of financial innovations. Against this backdrop of institutional failure and public outrage, Satoshi Nakamoto published a white paper on October 31, 2008, titled, Bitcoin, a peer-to-peer electronic cash system. It proposed a radical alternative, a decentralized ledger, or blockchain, in which no central authority, no bank or government, could exert control. Instead, a network of nodes would validate transactions through proof of work, an energy-intensive process that deterred fraud and ensured consensus. The elegance of the proposal lay in its simplicity. Replace trust in institutions with trust in cryptographic math and transparent, immutable records. The timing could not have been more poignant. The very systems Satoshi distrusted had just shown themselves to be brittle and prone to moral hazard. Here was a blueprint for a new paradigm, one that promised to eliminate single points of failure and the specter of bailouts at taxpayer expense. Yet the initial reception of Bitcoin was muted. In an era still reeling from bank bailouts and housing meltdowns, the idea of digital gold, backed by cryptographic scarcity and algorithmic issuance, seemed niche at best, quixotic at worst. Early adopters comprised a handful of cypherpunks, libertarian programmers, and academic researchers intrigued by the technical innovation. They mined the Genesis block, introspected the code, and exchanged tokens in bartered transactions. By January 2009, the first Bitcoin transaction exchanged 10 BTC for 2 pizzas, a legendary anecdote that underscored both the novelty and the uncertainty of Bitcoin's nascent value. Over the next 2 years, Bitcoin's user base crept upward, buoyed by fascination with its technological underpinnings and a growing community on mailing lists and forums. But mainstream financial institutions remained skeptical. Regulators issued warnings about unbacked digital currencies, and media coverage alternated between dismissive headlines and cautionary tales of illicit use. Yet beneath the surface, a foundational shift had begun, the notion that money could exist purely in code, without recourse to an issuing authority, had been made concrete. The core properties of Bitcoin, decentralization, transparency, censorship resistance, and predetermined supply, offered a glimpse of a system immune to the excesses that had brought down banks in 2008. By 2011, several key milestones marked Bitcoin's slow transition from curiosity to asset class. Ventures like Mt. Gox, the first Bitcoin exchange, enabled easier conversion between fiat and crypto. Developers forked the code to build alternative cryptocurrencies, or altcoins, experimenting with new consensus mechanisms and features. Services emerged to store and transfer coins, albeit with rudimentary security. Most importantly, the community embraced the idea of a global, permissionless monetary network, one that anyone with an internet connection could join. The foundational work laid in those formative years would set the stage for explosive growth in the following decade. As institutional investors and enterprises began to explore blockchain's potential beyond peer-to-peer payments. While Bitcoin's early days were marked by technical tinkering and ideological fervor, the lessons of 2008 remained integral. Every line of code, every cryptographic signature, and every network upgrade aimed to prevent a repeat of that catastrophic failure. The block reward halving mechanism, coded into Bitcoin's protocol, ensured that supply was finite and predictable. Unlike the unlimited printing by central banks during crises, the open, auditable ledger eliminated hidden leverage and opaque derivatives, making systemic risk far more visible. And the distributed network topology meant that no single entity could wield outsized power or crash the system by losing solvency. In essence, Bitcoin was conceived in the shadow of financial meltdown, designed to address the very shortcomings that 2008 had exposed. As we reflect on 2008's lesson in hubris, fragility, and the limits of trust, it becomes clear why blockchain technology captured imaginations around the world. From small startups in Zurich to academic labs at MIT, researchers sought to transplant Satoshi's design into industries plagued by centralized control and intermediaries. Supply chain consortia envisioned immutable provenance records, energy companies explored peer-to-peer microgrids, central banks began experimenting with digital versions of their own currencies. Though the road would prove winding, and the technology would face hurdles in scalability, governance, and regulation, the blueprint etched in Bitcoin's white paper offered a new paradigm for coordination. In the next phase of our journey, we will examine how this nascent ecosystem weathered its first major storm, the collapse of Terra Luna in 2022. That event, though smaller in scale than the global financial crisis of 2008, nonetheless revealed critical vulnerabilities within decentralized finance. But for now, let us pause and absorb the lessons of 2008. Excessive leverage breeds instability. Opaque structures hide risk. And in the worst moments, only radical reinvention can restore faith in money itself. Bitcoin emerged not from a vacuum, but from the ashes of institutional failure, its genesis block a bold statement that a new era of trustless finance had begun. In the years following Bitcoin's quiet emergence, a groundswell of experimentation and innovation transformed niche code into a burgeoning ecosystem. By 2012 and 2013, blogs and forums buzzed not only about Bitcoin but also about a new generation of alternative coins, altcoins, each promising to improve on some perceived limitation, faster confirmations, greater privacy, or novel consensus mechanisms. Litecoin offered quicker block times, Namecoin explored decentralized domain registration, Purecoin introduced proof of stake. Though most of these projects would fade into obscurity, they heralded a collective realization: blockchain was not a one-trick pony, but a versatile foundation for reinventing financial primitives. As the inaugural Bitcoin halving in November 2012 tightened supply, early adopters watched price charts with growing fascination. A token once traded for cents soared into double digits, then hundreds of dollars. Media coverage expanded from tech blogs to mainstream outlets, and with it arrived institutional curiosity. Venture capitalists began deploying capital into crypto startups. Hedge funds scraped together trading desks. Retail investors, lured by tales of overnight millionaires, scrambled to buy their first coins. Amid this boom, a critical innovation took root: stablecoins, tokens pegged to fiat value to offer price stability. Tether, USDT, launched in late 2014, promised to back each token with $1, though questions about actual reserves would dog Tether for years. The convenience of switching between fiat-pegged tokens and volatile cryptocurrencies without exiting on ramps proved invaluable to traders. Soon, USD Coin, USDC, DAI, and other variations emerged, weaving an essential liquidity bridge between traditional finance and decentralized markets. By 2017, the crypto landscape entered a fever pitch. Ethereum, introduced in 2015 by Vitalik Buterin, had unlocked smart contracts, self-executing code on the blockchain, and powered a flood of decentralized applications, dApps. Initial coin offerings, ICOs, mushroomed. Entrepreneurs issued tokens to raise capital, often promising revolutionary decentralized finance, DeFi, platforms, social tokens, or next-generation games. The ICO frenzy raised billions, albeit with a high ratio of vaporware projects and outright scams. Nonetheless, the idea of programmable money and decentralized governance captured imaginations worldwide. When the bull market peaked late in 2017, Bitcoin flirted with $20, Ethereum crested near $1.400, and the total crypto market cap approached $800 billion. Skeptics scoffed, labeling it a speculative bubble. Yet proponents saw deeper structural shifts. Decentralized exchanges like Uniswap, lending protocols like Aave, and automated market makers ushered in genuine permissionless financial services. For the first time, anyone with a wallet could earn yield, borrow assets, or swap coins without intermediaries. The programmable nature of smart contracts invited endless composability. One protocol could build atop another, creating complex, money Legos. Still, with innovation came fragile interdependence. Many DeFi platforms relied on collateralized debt positions denominated in volatile tokens. Liquidity pools often held concentrated exposures. Audits, a patchwork of volunteer reviews, left smart contracts vulnerable to bugs and exploits. Rug pulls, flash loan attacks, and governance hijacks punctuated the decentralized dream with sobering reminders. Code is law only if it's battle-tested and secure. Through two more full market cycles, 2018's aftermath and the 2020-2021 rally, crypto matured in fits and starts. Institutional custodianship improved, with BitGo, Coinbase custody, and Fidelity Digital Assets offering insured storage. Public companies bought Bitcoin for their treasuries. Countries explored central bank digital currencies. Layer 2 scaling solutions, from the Lightning Network to rollups on Ethereum, aimed to tackle cost and throughput hurdles. But most participants agreed, the promise of decentralized finance remained tantalizing yet unproven at scale. Then came 2022, and with it, a crash of its own. Terra, a blockchain project founded by Do Kwon, had risen to prominence on the strength of its algorithmic stablecoin, Terra USD, UST, and its sister token, Luna. Unlike fiat-backed stablecoins, UST relied on a mint and burn mechanism with Luna to maintain its $1 peg. Users could always swap one UST for $1 worth of Luna, and vice versa, theoretically anchoring its value. In a bull market, the system worked. Demand for UST soared, generating yield through lending protocols at double-digit rates. Luna's price exploded, and the combined market cap of UST and Luna climbed into the tens of billions. But in May 2022, cracks formed. A broader crypto market downturn put pressure on UST's peg. Traders seeking safe havens redeemed UST en masse, minting massive amounts of Luna to meet redemptions. As Luna flooded the market, its price plummeted, decimating the collateral base. UST dropped below 99 cents. Automated arbitrageurs rushed to exploit differential. Confidence evaporated. Within days, UST tumbled to as low as 15 cents. Luna's price, once above $100, collapsed toward zero in a death spiral. Billions of dollars of value evaporated overnight. The human toll was stark. Retail savers, drawn by UST's advertised, risk-free yields, lost entire life savings. Crypto hedge funds like Three Arrows Capital, heavily exposed to Terra's ecosystem and leveraged through various protocols, found themselves insolvent. Margin calls triggered forced liquidations. Counterparties yanked liquidity. Dominoes fell. Celsius, Voyager, and other lending platforms halted withdrawals, citing insolvency risk. Even ostensibly sober, regulated entities faced liquidity crises. The systemic shock rippled across CeFi and DeFi alike. A key lesson emerged. Algorithmic peg mechanisms, no matter how elegant on paper, could be fatally brittle under sustained stress and contagion. Unlike 2008's financial crisis, where central banks could backstop banks with lender of last resort facilities, Terra's code offered no discretionary intervention. No Terra Fed could print additional collateral. No authority could halt redemptions. The invisible hand, it turned out, could not catch a falling knife. In the immediate aftermath, regulators worldwide sharpened their scrutiny. The collapse became Exhibit A for the need to treat stablecoins as systemic utilities deserving of oversight. Reserve requirements and consumer protections. Project affiliates disavowed liability. Do Kwon faced investigations. Proposals for insurance pools and protocol circuit breakers proliferated. Meanwhile, Bitcoin and Ethereum, though unscathed by Terra's collapse, suffered collateral damage. Prices slid 50 to 60% from their late 2021 highs, wiping out trillions in market cap. Yet, even as seasoned investors lamented over-leverage and overconfidence, a countercurrent stirred. Some argued that Terra's failure was a cautionary tale, not a death sentence for decentralized finance. They pointed to the resilience of public blockchains, to successful hacks contained by protocol safeguards, and to emergent models like real-world asset tokenization and self-custody. They urged a renewed focus on decentralized governance, risk oracles, and cross-chain insurance. The community recognized that maturity would require rigorous security audits, transparent reserves, and robust economic modeling grounded in centuries of financial theory, lessons borrowed from the very institutions crypto once sought to transcend. As we ponder the parallels between 2008 and 2022, we see recurring themes. High leverage amplifies risk, opacity breeds mistrust, and agile intervention can stem calamity. In 2008, central banks printed money. In 2022, algorithms simply unraveled. In both cases, complexity outpaced understanding, and faith in new paradigms gave way to cold reality. Yet each crisis also spurred reinvention. Post-2008 reforms led to higher capital requirements, stress testing, and oversight. Post-Terra discussions advanced the taxonomy of stablecoins, ignited debates over on-chain governance, and inspired hybrid models blending algorithmic design with regulated reserves. This brings us to the heart of our inquiry. If Bitcoin or Ethereum suddenly vanished tomorrow, if consensus collapsed, if proof of work or proof of stake networks fractured, what then? Would the world revert to 2008's centralized intermediaries? Would a new decentralized alternative emerge? And, most pressingly, how can we build systems resilient enough to weather both human folly and technical failure? Next part, we will examine the ultimate stress test of blockchain's promise. A sudden disappearance of a major network, its ecosystem frozen or halted, and explore blueprints for ensuring continuity of money, contracts, and value in a world where trustless rails might momentarily collapse. We will speak with core developers, DeFi architects, and risk management experts who have designed contingency plans, hard forks, and fail-safe governance protocols to mitigate the unthinkable. For now, let us reflect on the arc from 2008's financial ruin to 2022's crypto maelstrom. Two crises linked by leverage, opacity, and the inexorable logic of panics. In each, the weak points, hidden liabilities or algorithmic pegs, broke first, cascading into broader distress. And in each, the survivors engineered new defenses, hard-won through pain. Imagine, for a moment, that tomorrow morning you wake up and discover that Ethereum's beacon chain, or Bitcoin's proof-of-work network, has spontaneously halted. Blocks have stopped producing. Transactions sit unconfirmed. Wallets show balances but no one can broadcast a new transfer. Panic reverberates through exchanges, custodians, and DeFi protocols. Is this a technical bug? A 51% attack? A coordinated shutdown? In that instant, the promise of decentralized finance, permissionless, censorship-resistant, always on rails, seems broken. To guard against such nightmares, core developers and risk management teams have devised a series of contingency measures. First and foremost are multi-client networks. Ethereum, for example, supports multiple independent clients, Geth, Nethermind, Basu, Aragon. If a critical bug is discovered in one codebase, others can continue to produce blocks, maintaining network liveness. Regular cross-client testnets and bug bounty programs further reduce the risk of a universal failure. Beyond client diversity lies the concept of a social fork, in extremis. Major stakeholders, exchanges, miners, validators, DeFi protocols, could coordinate a hard fork, deploying a patched client that restores consensus. While social forks carry governance risks and can split communities, as history has shown with Ethereum, ETC and Bitcoin Cash, they remain the ultimate backstop when automated consensus breaks down. On the application layer, decentralized governance modules such as on-chain voting and upgrade mechanisms, e.g. Tezos self-amending ledger, offer one avenue for rapid emergency patches. If a critical vulnerability emerges, say, a flaw in the EVM or an exploited DeFi contract, token holders could vote in a patch within hours or days. far faster than legislative bodies can act on traditional financial crises. But what about custodial services and exchanges? These centralized touchpoints represent both a vulnerability and a potential savior. In a network outage, custodians maintain off-chain ledgers of user balances. They can temporarily honor withdrawals or internal transfers while the mainnet is offline. Exchanges might suspend trading, halt, or circuit breaker to prevent cascading liquidations. In parallel, cross-chain bridges, protocols that lock assets on one chain and mint equivalents on another, could provide rudimentary continuity. For instance, if Ethereum were down but a sister network like Polygon or Rollup remains operational, users could migrate liquidity to those layers and continue transacting. Institutional players have also designed cold fallback modes, manual settlement auctions that reconnect counterparties via conventional banking rails, using stablecoin reserves to bridge the gap until the blockchain relaunches. Picture a weekend in which a major DeFi platform reroutes margin calls and liquidations through an internal ledger, then reconciles all positions on-chain once the network resumes. While imperfect, such stopgap measures contrast sharply with 2008's interbank freeze, where lack of coordination caused credit markets to seize entirely. Yet even the best-laid technical defenses can be undermined by human error. Regulatory intervention, or geopolitical pressure, a government insisting on a court order to freeze smart contract addresses, or compelling node operators to comply with sanctions, could effectively disrupt a network. That is why many blockchains emphasize permissionless participation. Anyone can spin up a node in minutes. In jurisdictions around the world, network sovereignty is thus distributed across a global diaspora rather than concentrated in a single country's data center, reducing the risk of coercion. Finally, economic incentives play a critical role. Token bonding mechanisms, slashing for malicious behavior, and fee burn schedules align participant interests with network uptime and security. Validators who go offline or attempt double signing lose stake. Honest nodes earn predictable rewards. By contrast, 2008's banking system lacked automatic disincentives for imprudent leverage. Witness the endless bailouts that left taxpayers holding the bag. In blockchain, bad actors can be penalized directly by protocol rules, creating a self-policing ecosystem. In sum, the resilience of decentralized finance against a hypothetical network halt rests on 4 pillars. Client diversity and rapid patch governance, to avoid universal code failures. Social coordination and fallback modes, enabling off-chain continuity and manual settlement. Permissionless, global node distribution, defending against geopolitical shutdowns. Built-in economic deterrents, ensuring that participants bear the cost of misbehavior. These mechanisms do not guarantee perpetual uptime. No system can promise absolute perfection, but they offer a layered defense far more automated, transparent, and programmable than traditional finance's reliance on central banks and capital injections. As we draw this exploration to a close, let us step back and reflect on the arc from 2008's banking meltdown to today's blockchain stress tests. In each epoch, complexity bred fragility. In centralized finance, opaque derivatives and hidden leverage brought the world to its knees. In decentralized finance, algorithmic pegs and over-enthusiastic credit creation triggered spectacular implosions. Yet each crisis yielded hard-won advances. From the ashes of 2008 emerged a more robust regulatory framework, higher bank capital ratios, stress testing regimes, and clearer disclosure requirements. The Federal Reserve and Treasury designed tools to inject liquidity with surgical precision. Most importantly, they recognized that transparency and accountability are the bedrocks of stability. In the crypto era, we see a parallel. Post-Terra reforms emphasize reserve audits for stablecoins, formal insurance pools, and open risk models. Leading DeFi protocols now undergo professional security audits, deploy multi-sig governance, and maintain transparent treasury dashboards. The community experiments with decentralized insurance, staking pools that compensate users when smart contracts fail. Each iteration nudges the ecosystem closer to maturity. What lessons can practitioners and policymakers draw from these twin journeys? First, Never ignore tail risks. Just as banks once assumed housing markets never decline nationwide, crypto enthusiasts once believed that novel code alone ensured stability. Reality proved otherwise. Robust systems must anticipate worst-case scenarios and bake in fail-safes. Second, diversity is strength. A monoculture, be it a single client codebase or a uniform underwriting model, amplifies systemic risk. Promoting multiple independent implementations, varied collateral types, and heterogeneous economic incentives makes ecosystems more resilient. Third, transparency fosters trust. Blockchain's open book design lets anyone audit flows and reserves, catching trouble before it metastasizes. While regulators may balk at unfamiliar technology, they ultimately prize clarity. Show me the assets. Echoed by a Federal Reserve governor in 2010, now applies equally to on-chain treasury reports. Fourth, governance matters. Crises will test leadership. Central bankers convened emergency Fed meetings in 2008. Today's protocol governing councils must convene rapid votes or emergency forks. Decentralization means no single CEO can act unilaterally. Networks must design clear escalation paths and communication channels. Finally, innovation and caution must coexist. Blockchains promise to dismantle outdated financial gatekeepers and unlock new modes of value exchange. Yet with that promise comes the responsibility to build secure, inclusive, and well-regulated constructs. The path forward lies not in unbridled experimentation alone, nor in rigid centralization, but in a hybrid ethos, melding cryptographic ingenuity with sound risk management. As you consider your own role, whether as a developer, trader, policymaker, or curious observer, ask yourself, how can I contribute to building the next generation of financial infrastructure that honors both the ideal of permissionless access and the imperative of systemic resilience? Because in the end, the true promise of blockchain technology is not that it obsoletes every institution, but that it teaches us to design systems where trust is not assumed but earned, where failures produce reforms, and where communities govern themselves with transparency and integrity. Thank you for joining part 11 of All You Need to Know About Crypto. We hope this deep dive, from the global financial crisis of 2008 to Terra's collapse in 2022 and the protocols guarding against tomorrow's unthinkable, has illuminated both the risks and the revolutionary potential of decentralized finance. If you found value in this discussion, please like, comment your thoughts, and subscribe for more explorations of crypto's unfolding saga. Until next time, stay curious, stay vigilant, and build responsibly.